Good day, fellow chart watchers. It's Greg Schnell, and I am here with the Canadian Technician Weekly Market Review. And this week, with the Bears have taken over the kitchen. We got lots to cover off, so I'm going to jump right in. To find all of my blogs, StockCharts.com, go to the Articles tab. Drop-down menu is on the right-hand side, and you'll find the Canadian Technician. Don't ignore this chart. And we just released a new Chart Watchers article yesterday or this morning, so you'll be able to grab that. That was Saturday, August 9th. And please hit subscribe at the bottom if you're interested in getting more articles. Contact information, you can always reach me at gregs@stockcharts.com and also on Twitter at SchnellInvestor. Our agenda today, the market moved lower this week after a terrible Monday and tried to rally the rest of the week, but it seemed to be losing gas by Friday, so we're going to cover that off. The US dollar continues to frustrate me, if nobody else. Can't really get a direction. It broke out, pulled back again. Commodities have a hammer candle on them this week, so maybe there's something there. But the global indexes fell pretty much worldwide, and I continue to think that's a bigger part of the problem. Copper, more frayed wire, just these industrial metals are getting weaker, and the big picture continues to deteriorate. So that's what we're going to shoot through. My optimism is not high for a bull market starting anytime soon, so not to depress anybody, but just... we'll go through the facts, the charts, and work from there. Actually, maybe I'll just take this down one notch. So first of all, I want to start on the bullish percent index. And why I want to start here is when we look at these indexes, what we see is this, we're at 45% here and 44% here. And just you can see that we've had a downtrend in highs, and then we had this kind of period where the market couldn't really decide, and that created kind of that first pullback, and then we wobbled. We had that same sort of thing show up in 2015 when we kind of went sideways but couldn't really get a lot of momentum up into the high zone. We had it back in 2007 and in 2006, and we wobbled, and then we ran into 2007. We haven't had that here. What we did was we went lower, and then we barely got up, and now we're falling down again. I will point out that around October of 2007, we got to about 50% on the bullish percent index, and that's all we could manage. Back in 2002, we had that same sort of level after a bounce off the low, and then we pulled back, and that was into the early spring high or low, and then from there we rallied out. So maybe that's what we got coming. We'll see. I think the reason I think it's different is this bottom panel down here is not at back then for that rally it was at like 20%. We're at 50% and rolling over. So I think the market breadth is too weak to get a major advance without a pullback. So the NASDAQ 100, we only have 47% of the stocks on a buy signal over here. And I thought I had updated these charts, but for some reason it didn't hold. 66% of the stocks are above their 200-day moving average. Now, the problem with that, that's getting close to the threshold. I would say when it gets below 60, that's kind of where we start to see water falling. So just keep watching that. We're pretty weak, but only 47% on a buy signal. I think that's a problem. Now we go to the NASDAQ 100 and we see the same problem here the New York Composite. And what we see is 45% of the stocks are on a buy signal. And again, the bounce up only got to 55, and you can see this downtrend. When we have these situations where we have no real strength after the rally, that's a problem, and that's kind of the area that I'm worried about. And so this is more like, March 2008, May 2008, October 2015, like in terms of the bounce level. So we come off the low, we come up, and we have trouble getting going. And I think that's the issue here coming up, having trouble getting going. Maybe this is, not going to play out this way, but so far everything on the map looks like that. And maybe we're over here in 2002 where we make a lower low and then we can go back and rally. I don't know where the rally where it stops. I just know that I don't see a lot of breadth and a lot of strength across the board. A lot of people will talk about, well, it's not the big markets. Well, that's because the small markets or the small stocks break down first. Everybody herds into the large caps. And and then leaves the large cap. So this is the trend line I've got for the S&P 500 going back to the 2009 low. It's, we still got lots of room here. We're at, call it 2850 or something like that. I've got some other charts we'll get to that show that. But the bullish percent index, if we're going to bounce the S&P, it's a pretty important place here in this 50% level. And again, we're down to 60% of the stocks above their 200-day, and that's kind of where they waterfall from. Now, it's not just the US that's weak, it's the rest of the world, and that is the real perplexing part of the problem. So we're going to go up here to the advanced decline line data. And the big picture on this advanced decline line data is while the market was trying to make higher highs, we were making lower highs in advanced decline. That to me is the crux of the problem. And now we've broken this uptrend. And when these uptrends have broken, they've been a good place to at least be aware of the market change in trend. And I guess I didn't close this, so let me just go do that. So one of the things that I'd be worried about here is that when we have this market pullback, one of the problems we've got is how far and how long, and we don't have the answers. I can't see the future any better than anyone else, but I can tell you the current state of the market. And it's very weak. And again, these declining tops make it a concern. So what we're looking for now is some sort of a setup that starts to change momentum. And if the market can start to do that, then I would change my tune very quickly. But we don't have that yet. And so here's the New York high low, or the NASDAQ high low. And what you see is we're barely, we got up to zero and we fell away again. So staying below zero isn't a place we really like to be. We saw this in October. We saw it briefly in January, February, and the market, kind of hummed around. We saw it back here in 2015 where the rallies only got up to zero, and that would be a problem. So anyway, so far that's where the rally has died. Now we'll watch next week and see if we get any more further price action higher. But at this point, it looks weak to me. And you can see our typical pullback level is kind of where we are now. And so a lot of people are saying we go higher. Those other places didn't happen. So let's just pick 2016 November. Okay, they didn't happen with weak breadths like this. November, we were way up here in breadth in terms of the percentage of stocks above the 200-day and the bullish percent index. This is the bullish percent index. But for the NASDAQ as a whole, we're up around 65%, not 45%. And down here, we had 70% of the stocks above their, well, okay, what's the number? Maybe I should go a little later here. 65% of the stocks above their 200-day moving average. And now we're under 45. So that's the gap. It's not one chart by itself. It's the package. And it's this continuing width or breadth of problem where all of these charts as a package don't have a lot of strength. Now, I have a chart that I'm going to show you a little bit of because it's quite confusing. But on that chart, it talks specifically about the NASDAQ. And what I've done is I went through and I made this model years ago. And as you can see, I haven't kept it up. But I kept up the notes up in here. What you see is we're falling below the 40-week moving average on the percentage of stocks above the 200-day. And down here, we're falling below the percentage of stocks on the 10-week moving average. And when both of those happen, it's a good time to start looking for short candidates. When they top out at 50, which is what it says over in here, that's another problem. And so both of these have done that. And so I'm in a perspective where this market is so weak, it could literally fall away like it did in 2015. Now, I could go through way more detail on this, but the big issue for me when I look at the market like this is that I have clearly enough weakness for the market to go lower. Now, maybe we get something that happens in Wyoming, in Jackson Hole, where all of a sudden all the central bankers get together and send this thing to the moon. But currently, the way my charts point, that's not what's about to happen. Okay, so we broke this 2019 uptrend line here at the beginning of August, and in last year it was the end of August that we broke that uptrend line, and if we used a more shallow one, obviously the market started to break down in October. We've broken this one uptrend for sure, and now I think the next place to be careful of is this. I'll call it line with a lower slope, and perhaps we can hold on to that. But all of this indicates to me, you can just see that, as the market came up here, we had a lot less on the advanced decline, and this led into the May pullback. I still think we have more to go, and we'll keep watching, but that's what the charts are telling me at this point. The New York high low with the Dow Jones, we're at 100, and again, that's just not enough to get a good rally going. So we'll keep watching that, but it's these pullbacks down here that take momentum out of the market. And so I would continue to suggest watching closely. I don't want to predict doom and gloom. I'm just saying the market doesn't have breadth, and we need to be respectful of that. So this is the S&P 1500 advanced decline percent, and you can see that we've clearly broken this uptrend here and fallen below it. Now, we can draw that line here, we can draw that line here. They were pretty good places to avoid. If the breadth was better, we'd be in better shape. We're not. Okay, let me go down and just start working through some of the summation indexes because I think they're important. Now, one of the things that this is the New York Summation Index, and this is about 4 years. And what you see on here is we're living below the zero level on the McClellan oscillator, and while that doesn't necessarily make it bad, you can see we were below zero in March, but yet the market kept going higher. The big issue for me is up here with the summation index, and we're now getting to this level of 400. And what you'll notice on the charts here are these red vertical lines when it crossed below 400. And it was an important place on the chart. So in here, we barely got a pullback, and then the market immediately reversed. I get that same thing here. But for the most part, falls below the 400 matter. And so as we hit this fork in the road, let's watch and see what happens. But to me, when we fall through this, the market will actually start to move down. So this is the summation index. So that was a few years of the summation index. This is a compilation going back to '05, and I can go all the way back. But here we're sitting at this 400 level, and again, the problem is we've come off these highs and we're starting to dribble lower. Maybe it's like 2010 where we just take out a prior low and then we go back and we start to work our way higher again. I just don't know. Pretty important stuff, though. I think the summation index is telling us something, and the Nasdaq summation index is already down around minus 200. Now, I will say if it doesn't bounce from here, like that's typically the bounce level that we would look for. So over the next week, let's just see where this ends up. But if this really starts to move down, like it did in the fall, in October timeframe, this is the kind of downstroke we'd have. And at that point, the market lost roughly 20%. So let's just keep watching. But both of these summation indexes, based on my work, are at critical levels. Okay, options expiration, we have that coming next Friday. That's always a place that I watch for the market to make a turn. In this case, we've been pulling back. We'll see if we can bounce out of it. We know that we just had the Fed meeting here in August, and once again, it coincided with a market top. We've seen this movie before. The picture back in September 2018 was this Fed meeting. Jackson Hole is later in August, and so that's where the central bankers from around the world come and meet in a beautiful place. And we'll see if they can get some coffee going and try to figure out what to do. But the real problem we've got here is, with this change in the market sentiment, I personally think it's a problem. And the reason I'm more skeptical is it's not just China, it's not just something else. Almost every market in Asia is below its 20-month moving average, below its 20-week moving average. Um, when we look to Europe, a lot of them are starting to break down. So it's the global weakness that I think continues to exacerbate the problem. So here's the S&P 500. We're down about 2% from a month ago, so from July 11th. And year to date, this market still looks good. You can see how important this level that we tested on Monday was. We came right down to it. And if I widen out the chart, that'll help people understand why that line is there. But we're right in where these prior tops are. And so we're trying to desperately hold on to this level. And now again, we're up against a resistance zone. So we'll just see if we can push through. Again, the way the market changes is all of a sudden you start to get breadth thrusts and buying in, and that would change all of the data I have. But so far it seems pretty weak. Okay, here's the S&P 500, just a weekly chart real quick, and you've got this blue line struggling here. Let's call it 2950. And then we've got the NASDAQ here at the prior highs. So these are all failed breakouts, and we've rolled back. On the Russell, we didn't get a breakout, and we've rolled back. So we're still continuing to monitor that. Okay, I'm going to pick up the pace here a little bit. So the NASDAQ has broken its relative strength uptrend compared to the S&P 500. Typically, that's a place to be cautious. I think that's what's showing up again here. We're just below zero. It could wiggle like this and come back up. Maybe something like back in that March-April time frame. Again, it's the breadth that's so weak that makes me think it's bigger. Here's the NASDAQ 100, and I will say one thing about this. It has not broken this 4-year uptrend. And so I'd be watching that as kind of the next issue. If all of a sudden they start to sell the NASDAQ stocks off, we're going to see this chart break, and it'll probably underperform the S&P 500. When that happens, that's just a better place to be cautious. And so you can see here we had an uptrend and it broke, and here we had an uptrend coming into 2012, and then the Fed stepped in, and then we went all the way up to the end of 2014, early 2015, and the NASDAQ corrected in there. And here we had another trend that broke. I've drawn this long trend line to kind of illustrate a bigger picture, but the NASDAQ typically outperforms the S&P 500, or the NASDAQ 100 does. And now we've got a PPO rollover at a relatively high level. We're still around 2%, but falling below this 2% with a lower high gives me a lot of caution. So this is trending down, and what it just says to me is momentum on each high is waning. Okay, nothing there. Let's just go straight to the Russell. Okay, so I think the Russell is the canary in the coal mine. I think everybody who has followed my work knows that I place a lot of emphasis on watching for the small caps to break down before the mega caps do. And so here we have the Russell rolling over. You can see on this PPO that we're right at zero, and we've just barely rolled over. But the big picture here is this downtrend in momentum. And in May, we rolled over, and I thought that was pretty cautionary. Then we managed to pull it back up, but just barely. And all of a sudden, for the 1-month thrust, we hadn't got much going, and now we're rolling back over. Now, there's a whole bunch of other data that's in the background here, but these charts are playing out the way we would expect. Okay, let's go to Canada. And what we see on the Canadian market, again, it typically follows with the Russell. The Canadian market should weaken. We're already below the 10-week moving average or the 50-day moving average, and we're below zero here on this daily chart for momentum. But you could just see these downtrends in momentum usually lead to market pullbacks, and we've just started. Okay, this is one chart that I don't think gets enough credit, and this is where every stock is equal. And what I've done on this chart, I've shown it a few times lately because it's in play, but we have a downtrending 40-week moving average. And just when you go back and look at the charts, that's not really a wholesome place to make a lot of money. And so we can add the S&P 500 at the bottom here or in the background. Let's just go get it. So we're going to use price. We're going to let's put it behind the price just so that we can see the two together. And then we're going to go with a solid line, pick your color. Actually, let's go with red just because it'll be so different. And then the height is fine. And when we put this line in here, what you see is that, it's not uncommon for this chart to weaken before the S&P 500 tops, and it starts to come down here and then it starts to fall away. But for the most part, the S&P 500 eventually catches up. So this chart's been weakening for not quite a year, and what we're watching for now is, can the S&P 500 turn everything around, or does this fall apart? To me, I think the answer's already in the chart. My momentum indicator is now below zero. Again, going back for the last few weeks, I've been explaining it, but this momentum indicator below zero is a problem. And so when the vast majority of stocks are actually in negative momentum and accelerating downward, that's a problem. And so I've got my little flag here on the full stochastic. We're barely above 50, and just typically when markets are downtrending, you stay below the or near the 50 and roll over. And you can see in 2000, 2002, that was kind of the case. So lots going on here, but again, it doesn't seem to matter what chart I pull up. They have problems quite distinct in my work. So here's the Shanghai Composite, and what do we see here this week? It is just barely above zero. When we look back to the left, and I mean, we can unwind a chart forever, but anytime you have negative momentum, this is a problem. And you can see we had, a big pullback and then rallied back up and then stayed below the 40-week moving average and below the 10-week moving average, and down she went. Well, we're just heading below zero now. We're going to be on our first week, so maybe we go sideways for a couple of weeks, that kind of thing. But again, the Shanghai, the Russell, the XVG, the Nikkei, I can add on and on and on of all of these charts starting to break down. Okay, so here we are falling below the 10-week and falling below the 40-week. We're at zero. Full stochastic could make a higher low here and bounce out, right? That would be excellent. But I think, look at this downward momentum. It's going to take a little bit of horsepower here to reverse this. So something pretty good has to come out of the China news, and my understanding is they're not getting together till September to start negotiations again. So that would concern us. So here's the Nikkei, and again, PPO on a daily chart. Most of the daily charts are now below zero. That's just a place to be careful of. It doesn't necessarily mean we're going lower. I prefer a bigger trend like the weekly. And you can see this Nikkei, well, maybe you can't see it, so I'll put on the zoom panel. The Nikkei is rolling over below zero again, and this week we got our first cross downward. It's just important to understand that all of this momentum is starting to weaken, and I liken it back to this 2015 period, and I think so many of the charts I have point to that same sort of October time frame. Okay, US dollar, let's get into the currencies because they're a real difficult mess. So again, we had the breakout last week, immediate reversal and pulled down, and we closed near the low of the week. But this PPO looked like it was going to start to break out, and now it hasn't. And so we keep juggling lower here, and I think we all know which direction everybody wants their currency to go. So this one is fighting hard to try and fall. We'll just see if that happens here, but I don't have any indication of the U.S. dollar becoming a weaker currency than the rest of the world. Anyway, we're sitting right at this 97.50 level. It's a level I keep watching. No real change. Okay, let's get excited here. This daily chart for the U.S. dollar coming down to test horizontal support and resistance. Can it bounce out of here? We fell below and immediately shot to the other side. What if we get above and immediately fall away? And you can see we've got our signal here that it's crossing downward on this daily chart. So perhaps now we're ready for the dollar to rip lower. That would be a surprise for me. Euro on a weekly basis. Okay, so again, major trading partner for the U.S., no tariff deal in place. That's one of the things that concerns me on the big picture. Here we have the 65-week moving average. We're below it. Typically, that's a pretty good friction level. Where the PPO is lower and has rolled lower. Now this week it kicks up. It doesn't necessarily mean it'll turn over, but we got to keep watching in here. We had a pullback, and now we definitely made a higher high and a higher low this week, and we took out the last 2 weeks. you know, it would. It's pretty obvious that this kind of level for the euro is pretty normal between 110 and 120. We've spent a lot of time in here. Let's keep watching, but no real trend break for me. Here's the German DAX up here, and you can see the trend line I've got. I've got another trend line that comes off this low. I think that changes that picture a little bit as well. So yeah, so here's the DAX, just horizontal, and what you see here is trying to hold this 12,000 level and can't really do that. We're falling below 11,750. The Eurozone, this is a daily chart, and you can just see in the last couple of months, we have just wandered within a few pennies here, back and forth, and haven't really made any progress. So I want to keep watching to see if there's enough thrust to get something going anywhere else in the world. And that, I think you'll find that's what we continue to review here. So here's my Swedish krona. It ended lower than any of these previous ones, so it suggests to me that the euro is probably going to roll back over here and fall harder, is what I would expect. Now, I do like the fact that it's broken above this trend line. Maybe it comes down and rolls out of here, and there's been some good examples of that, especially on monthly charts. But I think the important thing to remember is, at this point, price is making lower low. We have, if it started to reverse right here, this would be a higher low and maybe potentially helping us find a bottom in the krona and more influentially into the euro. If we look into the British pound, that's not what we see. This thing is on a train ride out of town on the Thames, or a boat ride out of town on the Thames, and this thing is clearly headed lower. There's no real momentum pausing here. It's accelerating lower. This is where Boris Johnson got elected. We're blowing through the previous lows, and I think my next chart is no, this is daily, so let's go back one, and we'll just expand out the chart just to get a feel for where we're at here on the currency. But you can see we're way down. We'll go here and make this whatever, 1984 or something. And when we do that, what you see here is, we're drilling in the bottom corner. We've now broken below any of this previous level. So the British pound is now breaking down significantly. You can see on the PPO, there's lots of room to move lower here. And so far, we don't seem to have any support showing up. So if the pound is plummeting, that should push up the US dollar. And again, there's no trade agreement in place there if Brexit goes through. So then we got another issue to deal with. So I think all of these are starting to line up as forks in the road, but without question making it very difficult for us to meaningfully advance the indexes. Here's the Nikkei with horizontal support and resistance, barely hanging on above this 20,000 level. I've been using the 21,000 level for a long time, because that was the market high from years ago. But again, one of the issues we've got here is the yen is starting to break out. Gold typically follows the yen, and you can see that pattern is worked out. Moving quite a bit higher here. And so if the yen is going to continue to rise, that would be US dollar falling. I have trouble with that. So maybe gold pauses here as the yen gets back up to this 95-cent level. It stalled there twice in 2018. So keep watching. You'll also notice that those were near the lows of the overall market. So this would be an interesting place to watch for deflection, but I haven't mapped that out as a strategy yet. So here's the Nikkei going higher for 4 or 5 years, 6 years maybe, and we'll just see what happens at this trend line, but we're pretty much right there. Pretty important place. Now the Japanese yen, from a momentum perspective, is breaking all of these downward trend lines. It looks like it wants to go higher. Let's just keep following. I think that's one of the clues that gold has probably got more room to run. So anyway, that's an interesting chart. And the other side of that trade on the yen, of course, we've got the Japanese central bank buying ETFs to try and hold things together. And so far this month, I think they bought every day except 2 or 3. So out of the 9 trading days or 7 trading days this month, they've bought 3 or 4 billion already this month. So we'll see if that keeps up. So for the Canadian dollar here, we briefly got up against 77-cent resistance, rolled back over, no surprise, and we're trending down here. Now we have broken this downtrend. Let's not put a lot of faith in that. If I went across the top, if I move that blue line up here now, just to kind of anchor it on these highs up here, uh, maybe that's a better fit. But we're still in this place where there's not a lot of upside support here. We're rolling over close to zero. So if this was going to fail, I would expect another move back down by the Canadian dollar. And when we go here onto the daily time frame, you can see we pulled back to the 77.50 level. That other line on the chart was up here. So let's just see where we go. But again, it doesn't seem to me like the dollar wants to go higher. We do have a slight upturn here in the moving average, 65 period moving average. Maybe it finds support there. We'll see. Australia, this chart just keeps pushing lower, so it made another lower low and lower high this week. The Aussie stock market, after being one of the lone standouts, rolled over on this most recent news, and this is as it was trying to take out the 2007 highs. So not a surprise that we got a little bit of resistance up there, but the real question is this Aussie dollar seems to just want to go in the toilet here. We're now at 9-year lows or something on the Oz. And that looks like a downtrend to me, and whatever, we get a bounce back up to 70. Who'd be surprised if it rolled back over? Anyway, lots going on there in the currencyville. This is the emerging market currency ETF, and you can see that copper tracks it pretty closely. Copper's leading it lower, and now the currency briefly started to break out of this downtrend, immediately gave it back and fell for 2 weeks. It closed in the middle of the range, so let's watch and see if there's any heartbeat there. But it looks to me like it's going to roll over, and I would expect that to cause the emerging markets up here, which has a trend line kind of in place, starting to break. So just more things that look like they're cracking. Okay, let's get into the bond market. Lots to go here. LIBOR rolling over and continuing to accelerate lower. And again, typically LIBOR follows the 2-year. But this is dropping. The trend of the LIBOR can follow 2-year Treasury. And as this is breaking down, notice the momentum's below zero. So this doesn't look like it's ready to pause yet. HYG, this continues to push down. Again, this is high yield debt, and this is unadjusted, so the yield is taken out of it. But notice this horizontal support and resistance level goes all the way through the middle of this zone. Maybe we could even move it up to where this 87-cent level is and catch this one. Whatever, we're in the range where it's kind of an if statement. We've just fallen below the 2018 level here, and starting to drop. Momentum is waning, and down we're headed. Now, while that might or might not give us some clues, what's more important is how it's doing relative to the IEF. And so this is the IEF, and this is clearly soaring to new highs, which is the 7 to 10-year Treasury bond price. And it's moving up, and it's getting very close to its 2016 midsummer high. And now if we go to the ratio, this ratio is now breaking down to new 3-year lows, and you'll see the last time this ratio started to kind of break down was October of 2015, where we started to fall below prior support. That's what so we have this level right here to get through. We've just gone through it this week or the last 2 weeks, and so now we're at new 3-year lows. I think we're seeing this same sort of movie that we've seen before. Liquidity, this is the corporate bond, LQD is the ticker symbol, and what we see here is pushing up to higher highs than it's ever been at. This is the highest weekly close, going back a long way. Again, unadjusted, so we back out the yield payment, but the PPO is showing us very, very high levels, and so people are moving towards safety. That's no real surprise, but again, as we start to see how this market behaves, we've got this big uptrend line here on the S&P 500. People are still moving towards safety this week, after a pretty violent week actually in the treasuries, but they're still moving towards safety. The tips chart is moving up to kind of where gold topped out in 2016, so midsummer highs again. We've mentioned that three or four charts already in the bond area here. So we're probably getting to some sort of an extreme that needs to rest a bit. We did get up to 143 back on the TLT. Again, unadjusted, we're at 140. So we got a little bit of more room we could run, and that would probably be an important inflection point. So just keep watching this chart for a rollover here, and perhaps that'll give us some breathing room on the bond side. But the BlackRock Municipal Fund continues to push higher, and that just tells me that the 10-year yield lower, price higher, wants to keep going that way. This is the monthly chart of the 10-year. We're way down here near the lows, and obviously everybody thinks it's going to hold. Keep watching this movie because it's playing out in real time here. This is quite a sharp drop, and again, as we get through here and this goes into a really oversold state, who wouldn't be surprised that we start to get some rallies? But again, all of the other charts aren't exactly saying things are getting rosier, and I don't just think it's the Treasury Department that's got the issues. It's worldwide. So 5-year tried to bounce this week, actually made a couple of day high there, so that's a nice change. As the market bounced, so did it. And then here we have the 2-year, and it also rallied for the final half of the week. Doesn't make the whole trend thing go away, but we're watching that. Obviously, we're banging down here on the 30. We can do that quite often, actually, when we start to make market tops. So who knows? Okay, here is the yearly 2-year, and you can just see, we've been running up here. Just think big picture, the stock market's really been rallying from that 2012 when the Fed stepped in, rallied all the way up. All of a sudden, we got this giant red candle, and the real question is this marking a big trend change after 6 years? US 2-year, just going into a weekly chart here, you can see this continued rollover. This is a bit of a problem, obviously. It doesn't look like it's supported. We're clearly at 52-week lows, and if we got down here below 120, we'd start to drop, to new 2-year lows. So big picture, RSI falling below this 40 level, not very comfortable. When it starts to drop below 50, that's kind of when I think the stock market tops out. But one thing it seems to have surprised me with is perhaps it's more when this PPO goes below zero, and we haven't done that yet. So in 2007 we did, in 2016 we never did, this 2015-16 period, and back in 2000 we rolled over here, and it was late in the year that the S&P actually started to fall away. So keep watching as this market rolls over. Again, this negative momentum on a monthly chart, just telling us that things are weak. It doesn't necessarily mean they're all falling apart, but it's the price action around the rest of the world that starts to add up for me. This is the 3-month chart, and one of the things about this 3-month chart, plummeting lower, and it closed the week still going lower. Let me just go see if I have a chart. Imagine that. The one thing I like to show on this picture here is that when we had big recessions before, and I mentioned this last week, was this chart was downtrending, and 2007, 2008, that's kind of what it looked like. 2000, 2001 started to break down. Now it broke down in 95, but the S&P continued to go higher, so it's not a one-way trade here. But these gray shadowed areas are recessions, and obviously I haven't marked any sort of a recession on the chart here, but it has been about 10 years, and you can see that's kind of one of the widest areas on the chart. So who would be surprised if we had one? Okay. So continuing to work through, I don't know that there's a whole bunch more. In the 30-year bond area, again, we've gone to an extreme. The big thing that I think we need to focus on are the individual sectors now. And again, the transports have been underperforming the industrials. So the industrials are sitting up here trying to hit their prior highs, and we have a chart of that here. So they're sitting relatively tight and trying to bounce off the 40-week moving average this week. PPO has already rolled over again, so we're starting to fall down right at the point where This prior trend line was in place. So from a momentum perspective, things look pretty weak to me. Now, we could draw a little line across the bottom of these, much like over in here, and that would just suggest we've got another, leg higher going. At this point, the chart's pointing down. Last week, it was just kind of flat. This week, the histogram started to expand lower. I do agree we got a nice bounce off the 40 week. Let's just see where it goes from here. But going back to the transports now, you'll remember they're not anywhere near their highs. They're a lot weaker. Let's just go to the weekly so we have the same sort of scale. And you can just see that we've been making lower highs for a year. So as this drops, the momentum is right at zero. And usually, again, when everything goes below zero, that's a good place to be cautious. We're at zero. We're pointed down. This week we got our sell signal on the transports. We're right at horizontal support and resistance, and we've spent a lot of time there. That's a good clue, but look at this, the full stochastic rolling over here. We saw this in late 2018. Boom, down we went. Going back over to 2015 as the market topped out here in May, the transports continued to get weaker. We have all of those same dynamics. We have the full stochastic rolling over. And here, this is an upthrust, an upthrust, an upthrust, an upthrust, an upthrust. This is one place where it rolled down. That was January 2018. And we started to work our way down. Here it was an upthrust. Here we rolled over. And it's this change in trend, right? We get the rollover in the full stochastic as we're falling below zero. Place to be cautious. I suggest we're there. Okay, getting into the airlines. That chart's just so frustrating. Continues to work its way sideways. I agree Delta Airlines broke out to a new high, but that's about all we can say for the airlines. U.S. airline index on a weekly chart, 5 years of no money, so hard to invest in that. Looking at the railroads. Now, I started to talk about the railroads had better bounce here, and one of the reasons I said that was because it's a good economic indicator for the U.S., and you could see that this 2-year trend line has broken, and so that was concerning. And now the railroads are starting to break down, and I know nobody else wants to use this chart as a reference point, but I do. And one of the things we see is this 2-year trend line on red broke, but now the 4-year trend line has broken this week. And so, again, it's 1 week. It doesn't make anything bad, but it's this compilation of everything I have shown you leading up to suggest that there's more weakness. Now, back in the end of December, I mentioned that we had gone below zero, and that would be an important place to watch to see if the market ends up making a final high up here. If you look left on the chart, you'll see 2012. We got below zero, and then we rallied back up, and we stayed up here. Now, the difference is this was quantitative easing infinity level, and we haven't got that going yet. So unless the Fed wants to step in September again, which is when they announced the quantitative easing back in 2012, the stock market actually pulled back for 6 weeks after they announced the golden handshake, and then took off to the upside. So let's just watch and see what happens when we get down to zero here. But it's this 4-year trend that's breaking that I'm concerned about. And we saw that in early 2015, and that was a good place to be cautious. So I throw that out there. I think it just adds on to the pile of data, but we'll see. Anyway, trucking. Again, sideways, not making any money. Looks to me like it wants to roll over right at this zero level down here in terms of momentum. I don't know how many charts I'm saying we're rolling over at zero on, but it seems like just about everything I look at. The autos rolling over at zero again. GM and Ford look okay. Tesla actually held up nicely this week, but we got charts like Nissan that bother me. They're making major lows. Let me just run down and show you that chart because I think it's a little bit important. There we go. So when we look through the car business, and the only perspective I have on this is historical. So I am no car guy expert other than I drive a car. Let's just pick 18 years. Okay, so Ford, it's been pretty clear, not really a whole bunch of money to be made, but they're trying to hold it together. Cool. But you can see way down here was the 2008, 2009 low. Ford got down to 71 cents and rallied to $13. That was some money. When we look at the Nissan chart, well, here's Chrysler, Fiat Chrysler. it's just trying to hold this trend line, and it held in there this week. It didn't get sold off. PPO right at zero, so but no volume either. Nobody showing up to buy the stock. GM, this chart's been holding up. It's up near its highs, and trying to hold up here. The PPO is starting to lose a little momentum, but nothing serious. I'd say that chart still looks pretty good. And relative to going back to the 2016 lows, it's pretty nice. It's above 32 bucks, and this thing rallied up to $41 off the May lows. So in 2 months, you're up 25%. You can get by on that kind of return. Let's go to Honda Motor. Now we got the other perspective here. We're down at the $24 level. Let me unwind the tape here, go back a few years. And what we see on this chart is we're really starting to break down. We're very close to breaking below the 2016 lows, and that puts us in 2009 territory. So very concerning. And again, this is one Japanese automaker. Now let me show you the chart for Nissan. Okay, this one's already broken below the lows of 2015-16, but when we widen out the tape here, we're definitely broke all the way down. This is 10.98. We're sitting at 12 bucks. So we got a little bit more to go to get through the $10 or the 2010 level. But remember when the car businesses kind of fell off the rails here? Like I don't know if if Nissan's going to need money, but they made the Leaf project, which was their electric car, and it doesn't seem to be driving consumer demand. And quite frankly, the right side of this chart looks downright ugly, and I would suggest it's much more in play like 0708. So anyway, I throw that out there because the Japanese government doesn't have any money to bail out these car companies. So we'll just have to see how that plays out. But that's one of the things that is starting to hit my mind is Japan's already weak. Their charts aren't working. And now these car charts, which is a major part of their business, or export business, is starting to flail. Okay, U.S. Automobile Index, this thing is trending down, rolling over at zero. So again, another issue there. But again, Ford and GM look okay. Broker dealers, I mentioned this in the Chart Watchers article. This is a leading group. It tells us when things are going well. And what we see here is it didn't close anywhere near the bounce we got in the S&P 500. This thing closed right near the lows. PPO rolling over at zero. Lower highs, lower lows, lower high. Now we'll look for a higher low, but we don't see that yet. This week we got our sell signal, and that's the PPO going below zero, or PPO going below its signal line. Hasn't quite gone below zero, but look at the relative strength. All of a sudden we're breaking down to new 3-year lows. That's a problem. And in something like the broker dealers, one of the things that's interesting about this pattern, there's a lady named Tony, and I'm trying to pick up her last name very quickly, but she did a lot of work on market patterns. And you see this high come in, then you see the market pull back, and then 3 drives to a high. And then on this third drive, if it can't actually accelerate out, it tends to accelerate lower. So this is almost an exact map of what Tony Hansen had created. And so here you start to see this roll over, and we're sitting right at this zero level. It looks pretty concerning and compelling story-wise to me. The utilities trying to push through to new highs here. And again, why wouldn't they? If the market was going to do what I think it's going to do, we should look for support in that utilities area. XLI, again, they bounced off the lows, which was nice to see, and made a higher low so far than the May low. But again, the PPO signature on that is lower. Okay, semiconductors real quick. Last sector or last industry group here. This chart is trying to trend higher. I think the bigger picture to watch for is on this weekly chart, and it looks to me like we're going to put in a lower high in momentum as price made a higher high. So we've got an uptrend here so far, and if that holds, that's excellent. I would just say that the PPO rolling over at this 80 level is a bit bearish, and then the lower high in momentum here is obviously a concern. But we're starting to break through this uptrend line on the PPO. This is an important week for the semis, in my opinion. If they start to bail now, that will really kind of add to my indigestion. CRB, this is the monthly candle here. And so obviously we're only 2 weeks in and big down, and we're now in the middle of the range. US dollar sitting right at this 97.50 level, just continuing to torment us one way or the other. But the more important thing is look at the weekly chart. What we had a nice big hammer candle coming off the lows right down where the previous lows were. And so that might suggest something happening here. But we did get a break in the PPO trend line. And again, this is also what the S&P 500 did. So perhaps it's a relief rally. Maybe I'm wrong and everything turns around here. But the momentum and breadth is so weak on just about every chart that, we need something pretty significant to kickstart the whole program. Getting into the commodity, DBC is the commodity tracking ETF, and what we find on, or a fund, what we find on it is we're down near the 2019 lows here, trying to bounce out of the hole. Cool. I think one of the things that was really concerning this week was oil actually tried to rally the last couple of days, and the energy stocks just forgot to join the party. Here's West Texas crude. You can see we've now broken the uptrend line that goes back to the December lows and May lows. That looks like a problem to me. Natural gas continues to bleed and is down under the 220 level, 212 to close the week. Heating oil, clearly a downtrend established here. Any sort of horizontal support line or uptrend line we might have had is now broken. We took out the May lows on the close. Same thing on gasoline, and it's the gasoline kind of thing that I'm noticing quite a bit. When gasoline starts to make lower highs, that's a concern for me. And if we just unwind this tape. Okay, so all through 09 to 2014, we fell down here. Remember 2015, bit of a problem party. And then we came up here and tried to run up. Now we make a low. Now we make a lower high. It just doesn't look very good. So that's kind of one of the things I'm worried about, that move down in gasoline. And you can see that this diesel trend line here, heating oil, if that starts to give way, I think that would kind of confirm my worst fears. Corn, soybean, and wheat were below the 10-week on all three of these. They just can't get going. It's amazing. I don't know if you saw the charts on Mosaic this week, but it just got crushed. Gold and silver continue to move ballistically. Copper held on this week, didn't continue to fall, so I guess that's good news. And then looking to the left here, we're trying to hold the 2017 lows, but we're at 2-year lows right now. Livestock chart just went sideways this week, so no real news. But again, that chart's not that happy either. Here's sugar rolling over below the 10-week, and coffee is down here. I toured the Kicking Horse Coffee Company in Invermere, BC, Canada this week. What a great tour that was to go check out the coffee roastery business. They make 9 million pounds of coffee in the middle of nowhere, so it was quite a cute little story. Cocoa, big uptrend on this chart, has now broken this week, and you can see that cotton pretty much left the farm. Marijuana stocks idling sideways, just a weird concoction of stuff going on. Everybody talking about the edibles market, but all of these charts made their highs back when marijuana was legalized in Canada around October 2018, and then that was also when the stock market fell. But on the next bounce up, they didn't do any more. Now you see this very clean downtrend here. If we start to see some improvement as edibles become legalized, maybe there will be another thrust. And some of the, I'll call it unknown names, started to have a pretty good week this week. So I'll just say I'm looking over there. I don't really see anything yet. You can see that the coal ETF pretty much forgot to fire up this week, and steel, nothing was getting melted other than the price. So big problems in those arenas. Looking at lithium, continues that ETF just, I think that's a 2-year trend, downtrend. And looking at rare earth strategic metals, well, they aren't falling. They aren't going up either. Both of them are below the 10-week moving average. Okay, here's we're not going to have time to go into all of these little groups. I want to cover off XLE. We're trying to hold these lows, and again, I just showed you that gasoline chart. That doesn't give me the the belief that's going to happen. This is the oil refiners, and this is quite, when you think of a basketball and it bounces and it bounces and it bounces and it bounces, does this look like to you it's going to fall? And look at where the full stochastic rolled over. That looks really bearish to me. Royal Dutch Shell plummeted in the last couple of weeks. Starting to see big names like that drop hard. Frac, way down here, took out the December lows, 979 this week. That's just ugly. And then on the weekly chart, hard to really want to say you want to put in a buy order right here, but we're trying to hold this 971 level. What was our weekly low? 979. So far we haven't taken out the 2016 low. Yahoo! But a downtrend here on momentum, and if that was to start to break, perhaps we could get on board. But the rest of the story doesn't seem to line up that way. One of the things about crude is it broke this uptrend line but held the May lows. So now the real question is it like we broke through the trend line and now we get a kick all the way to the other side of the party? Or was just we tested support, now we'll come up here, roll over at the moving averages and just fall back down? So far that chart doesn't look like strength to me. On the weekly, the full stochastic rolled over here. It looks like it paused on downside momentum this week. So gives me some hope. Let's not get too carried away. But some hope with two slope down moving averages. I'm not really expecting a lot out of it, especially when I look at the rest of the charts. I'd be happy to be disappointed and have been wrong. Okay, XOP. Up here in the top, big downtrend line on this daily chart. And if that was to start to perk up, perhaps we could get some interest. So let's call it above 26.50. Might be interesting. Like crude oil, stuck here below this long-term level of $59 and PPO right at zero. So maybe we get some sort of a bounce. But again, the rest of the charts don't seem to indicate that to me. Nat gas 3 years, that's pretty much getting close to the lows. We're at $2. Again, when we unwind the tape on this chart, this is kind of the level we would expect some sort of a bounce out of. We haven't had it yet. Kind of called for it in here a couple of times and it just hasn't worked out. But I continue to think when it gets so oversold, these are such big rallies off the lows that they make it pretty enticing to want to pay attention. And it's also not correlated to the S&P 500, so that makes it even more interesting. Okay, got a couple of minutes left here, so I want to fire up uranium. Nothing new. This chart continued to be dismal, working down into the bottom right-hand corner. When we get into the copper chart, it's no better. Still hovering here around this trend line, but we made lower lows, lower highs this week and closed slightly better than last week. Looking at steel, that chart was crushed. Making new, did we get new 2-year lows? 33.66, 33.33. So new lows there. That takes us all the way back to a new 2-year low, and we rolled over at zero on the PPO. Heard that movie before, or heard that expression? I feel the need for speed. We need some of these charts to start to turn. Okay, gold continued to have a great week, pushed up higher. When we get into I'm just going to go straight to the gold miners. Looking at the gold mining charts, pushed up and closed near the highs. This was just a great setup and off and running. So I like to see that. The gold ratio, the miners to gold, continues to perform. And if this trend line starts to break, I'd get more cautious. I actually thought it broke here and then it turned around and rallied again. So some continued upside for that move. Silver continues to look good. Pushing higher, and again, all of these charts were set up nicely, but they're finally following through. One thing that actually doesn't make too much sense to me, so lumber continues to look messy, but what we see here on the wood chart is even messier. It's starting to break down to new lows. So very worried about the home builders, but we'll continue to watch. Anyway, that's a wrap for this week. Thanks for taking the time to join me. I hope there's some information in there. Stay cautious and protect your capital. Thanks, everybody. Bye-bye.